China's economy is recovering faster than other countries after the pandemic thanks to its effective control of the virus and its stimulus measures to boost domestic demand. In this section, we will explain what sectors are driving the growth and how you can profit from China's recovery without buying Chinese stocks. One of the main drivers of China's economic recovery is its industrial output, which grew 2.4% year-on-year in the first 2 months of 2023, according to the National Bureau of Statistics, (NBS). This was supported by strong exports, especially of high-tech products such as electronics and medical equipment, as well as robust infrastructure investment, which surged 9% year-on-year in the same period. China's industrial sector benefits from its large and diversified manufacturing base, its technological innovation, and its integration with global supply chains. Another key driver of China's economic recovery is its consumption, which rebounded sharply after the reopening of the economy. Retail sales jumped 3.5% year-on-year in the first 2 months of 2023, reversing a 1.8% annual fall seen in December 2022. The consumption recovery was led by the catering sector, which saw a 9.2% year-on-year increase in revenue in the same period, as people resumed dining out and traveling. China's consumption sector benefits from its huge and growing middle class, its rising disposable income, and its digital transformation. China's economic recovery is expected to continue in the coming months, as the country has largely contained the pandemic and has rolled out a massive vaccination program. Analysts forecast that China's GDP will grow 3.6% year-on-year in the first quarter of 2023, compared with 2.9% in the fourth quarter of 2022. China's economic growth target for 2023 is above 6%, which is higher than most other major economies. So how can you profit from China's recovery without buying Chinese stocks? One way is to invest in you. Companies that have a large exposure to China's market and benefit from its growth. For example, many companies said China's recovery helped their quarterly sales, such as Apple, Starbucks, Nike, and General Motors. Another way is to invest in sectors that are related to China's economic development, such as technology, healthcare, e-commerce, and green energy. These sectors are likely to see strong demand and innovation in China and globally. In summary, China's economy is recovering faster than other countries after the pandemic thanks to its effective control of the virus and its stimulus measures to boost domestic demand. The main sectors driving the growth are industrial output and consumption, which benefit from China's large and diversified manufacturing base, its technological innovation, its huge and growing middle class, and its digital transformation. You can profit from China's recovery without buying Chinese stocks by investing in you. Companies that have a large exposure to China's market or in sectors that are related to China's economic development. Investing directly in Chinese stocks may seem like an attractive way to profit from China's economic recovery, but it also comes with significant risks and challenges that investors should be aware of. Some of these risks include regulatory uncertainty. China's government has been cracking down on various sectors of its economy, such as technology, education, gaming, and real estate, imposing new rules and restrictions that can affect the profitability and growth of companies. For example, Alibaba, one of China's largest e-commerce and technology giants, faced a record $2.8 billion antitrust fine and had to restructure its fintech arm and group after its founder Jack Ma criticized the regulators. Other tech companies, such as Tencent, Didi, and ByteDance, have also faced increased scrutiny and regulatory pressure from Beijing. These actions can create uncertainty and volatility for investors who own Chinese stocks or plan to buy them. Political tensions. China's relations with other countries, especially the EU, have been strained by various issues, such as trade disputes, human rights violations, cybersecurity threats, and territorial claims. These tensions can escalate into sanctions, tariffs, bans, or even military conflicts that can harm the Chinese economy and its companies. For example, the U.S. government has imposed restrictions on Chinese companies that are deemed to have ties with the Chinese military or to pose national security risks. Some of these companies, such as Huawei, SMIC, and Xiaomi, have been barred from accessing U.S. technology or capital markets. These measures can limit the growth potential and competitive advantage of Chinese companies in the global market. Currency fluctuations. Investing in Chinese stocks exposes investors to the risk of currency fluctuations between the Chinese yuan and the U.S. dollar. The exchange rate between the two currencies can be affected by various factors, such as interest rates, inflation, trade balance, capital flows, and government policies. A stronger yuan can make Chinese exports more expensive and less competitive in the global market, while a weaker yuan can erode the value of foreign investors' holdings in Chinese stocks. For example, in 2015 to 2016, China devalued its currency by about 10% to boost its exports and stimulate its economy amid a slowdown. This move caused a sharp sell-off in Chinese stocks and triggered capital outflows from China. These are some of the major risks and challenges of investing directly in Chinese stocks that investors should consider before making their decision. While China offers many opportunities for growth and diversification, it also poses significant uncertainties and dangers that can affect the performance and returns of Chinese stocks. Therefore, investors should do their due diligence and research before investing in China and be prepared for potential losses or volatility.